Good morning, everyone, and welcome to our Series-A Fundraising Workshop. We're thrilled to have you here today. My name's James Bamford, and I'm a host for today's Fireside Chat. Today, we'll be diving into the world of Series-A fundraising. Rather than the traditional presentation format, we've designed this workshop as an interactive fireside chat. Our moderator, Victoria Hoffman, will lead the conversation. Ben McClure and Marie-Caroline Haméon from the EIT Access to Finance fundraising team share their invaluable insights and expertise. We encourage you to share your thoughts, experiences, and questions in the chat function. Feel free to drop your questions there, and we'll address them during the dedicated Q&A session at the end. Now, let's give a quick overview of the Access to Finance services. At EIT Digital, we have a dedicated pan-European fundraising team located in the main European investor cities, including Berlin, Madrid, Helsinki, Paris, Belgium, and London. We have extensive experience in fundraising for tech deals due to our direct network of well over 1,000 tech investors across Europe and beyond. We focus on fundraising rounds in the range of 5 to 25 million, spanning pre-Series A, Series A, and even Series B. Our mission is to dramatically improve the odds of fundraising success for founders like you, even during these challenging market conditions. We help founders get ready for investment. We connect founders with the right investors from our vast network, and we deliver a highly efficient structured fundraising, allowing you to concentrate on the important job of business growth. Fundraising in 2023 is tough. The pressure is on the founders. The team is here to help navigate the fundraising journey and achieve your goals. Now let's dive into the workshop and explore the strategies and best practices that will empower you to raise your Series A round successfully. Victoria Hoffman, our moderator today, is the ecosystem lead for Western Europe at EIT Digital. With her extensive background in EU funding, venture capital and corporate investments for European deep tech startups, Victoria brings a wealth of knowledge to guide our conversation. Joining Victoria, we have Marie-Caroline and Ben from the EIT Digital Access to Finance team. These two have a vast amount of experience supporting digital tech ventures with fundraisings and getting deals over the line. Super connected in the VC space, these two, together with the rest of the Access to Finance team, are the right people to call on to help get successful venture finance deals done in today's tougher market. A seasoned, energetic fundraising advisor with decades of experience in the startup world, Ben sits in London, where he works to raise capital for Europe's top digital tech ventures. Marie-Caroline, a Parisian in Brussels, is an experienced deal maker and has been instrumental in bringing investors to the table from across France and the Benelux region. Ben and Marie-Caroline will explore the intricacies of Series A fundraising, share their experiences, and provide practical insights to help you on your fundraising journey. Remember, your active participation is key to making this fireside chat a valuable experience. So use the chat function to share your ideas and ask questions. So let's kick off our Series A fundraising fireside chat. I'll hand things over to Victoria, who will get the conversation started. Thank you.
Hi everyone. Glad to be here, and thanks for the introduction, James. Time is precious, so let's jump straight to the first question. I recently came across an article by the Financial Times that venture capital funding for startups has plunged by more than 50% in the past 12 months as an economic downturn weighs on valuation at tech groups. Clearly, this is going to make it more challenging for ambitious European tech venture founders to scale and grow the businesses. So what should founders do, Ben?
Thanks for the question, Victoria. Hi, everybody. Hi, everybody online. Great to be here. What should founders be doing? I think in these more difficult conditions, it really makes sense for founders to be getting help from an experienced team. The Access to Finance team here at EIT Digital, we really think that we're delivering a better way to raise capital. We are independent, motivated, experienced team of venture finance professionals. The team is made up of a very interesting group of people. We're former founders, corporate financiers, startup advisors, and even former venture capital investment managers. We have an intimate knowledge of venture capital funding and the deal-making process.
Yeah. Hi, everyone. So, yeah, we are located across Europe, and we are a body of the European Union, so we can bring to the table a strong and direct network of investors from across Europe and beyond. So we are quite proud of this valuable network of more than 1,000 investors we've built in Europe.
Yeah, and going back to the team, we all have at least 20 years of experience under our belts. Importantly, we've worked in all kinds of market conditions. There's a little bit of gray hair here. You know, we've been around for a while, so very little scares us. We've lived and worked and helped to fund and grow businesses through recessions. Some of us through the recession of 2000 and 2008. So we can bring that kind of experience to founders who are doing their fundraisings in 2023.
Indeed. And thanks to this experience, the Access to Finance team knows exactly how to raise money from top VC investors from across Europe, even in more challenging times, and especially in more challenging times. You know, some founders want to raise their Series A rounds on their own. Often the decision to go it alone is based on self-serving advice from investors who prefer to have influence titled in their favor.
Yeah, and you know, our real strength with that in mind is that we're independent. We're not working for investors. Our job is to make sure that the companies that we're supporting are coming to the table with the right investors from all over Europe. Backed by the European Union, we work for the founders and not for any particular set of investors or corporates. I mean, just going back to what's important these days, even the best companies now are getting advice and support from third parties. Founders, you know, many of them don't have that much experience with fundraisings, and I think experience really counts. I always think of my my father-in-law. He's a weekend sailor. He's an amateur. He likes to go out into the bay by himself in calm water when he's confident, but he doesn't typically go out into rough seas or winds. And when he does, he usually brings in somebody who's more experienced. So our view is that founders should really work with its experienced team of advisors. It can make all the difference particularly as they're growing their businesses in today's more turbulent market.
So we invite founders to learn more about our team, what we offer at EIT Digital Access to Finance. We really help make 5 to 25 million euros fundraising more efficient and successful for the founders. We are here to ensure founders have a strong investment proposition and also are well prepared for the investors' roadshows.
Yeah, so we match you with the right investors from all across Europe and beyond, even into North America and Asia when needed. We get you in front of the investors that are going to most appreciate your business, and importantly, we're going to help you navigate the whole fundraising process, which can be quite complicated. And deliver an effective, streamlined fundraising campaign that lets founders spend more time on the critical work of managing and growing their businesses.
So we organize also meetings, we follow up with investors when need be, in order to keep the momentum during the campaign. We review, we analyze the term sheets to ensure that all the terms are fair and align with the market conditions, but also with the founders' expectations.
Okay, so talking about the market, tell us, how do you see what's happening in the market? Is it all bad news for companies seeking Series A funding, as seen in the media?
Very important question, Victoria. Thanks for this. There is a downward pressure, to be sure. It's really palpable. It's discussed almost every time we speak to founders and investors. But the good news is that record amounts of venture capital is available and ready to be invested in exciting technology companies. And in this industry, we call this dry powder.
Yeah, there's actually plenty of dry powder available. You know, over the last 3 or 4 years, more and more institutional money, i.e. money from the big pension funds and investment managers and asset managers, has been flowing into venture capital funds. These large institutional investors know that the best returns are coming from early stage innovative technology businesses. So more and more money has been going into venture capital funds.
Indeed. And just consider the new funds launched quite recently. You know, we have this North Zone VC fund, a big European VC firm, which has raised 1 billion euros fund. It's largest to date. I can also talk about the Swedish private equity firm, EQT Partners, who has raised its third fund of more than 1 billion euros as well. And this one is really looking for increasing investments in tech startups in Europe. Also in France, we have Partech, which raised 100 million euros for their Partech Entrepreneur 3 fund. This fund focus is on startups closing seed rounds. Balderton also raised about 500 million euros early stage fund to back Europe's next wave of breakout technologies. We can talk about also Index Venture, who raised about 300 million euros seed fund to really focus on extraordinary entrepreneurs. Speed Invest also, a pan-European early VC, we are raised 500 million euros in new capital to help European startups scale across Europe. And also, on top of that, we have regional funds in several Eastern Europe who raised it as well. So, you know, this dry powder is plentiful. It can't be invested solely into existing portfolio companies. VC fund managers have a duty to their LPs to put that dry powder to work. Consequently, they are under pressure to find and invest in great tech companies.
Yeah, so there's dry powder available, but even more than just the money, we're seeing more investors looking with more interest at earlier stage investment opportunities, particularly pre-Series A, Series A stage financings. So more and more investors are recognizing that Series A stage opportunities, they have quite a long time to kind of achieve a desirable outcome. You know, there's a good 10 years for the company to come to fruition, sometimes even longer. And this longer time horizon enables these investors to see through today's uncertain market and through the turbulent exit environment, and it makes it much more interesting. So as we said, you know, our team is in constant contact with the market and with investors, and we've been hearing from more investors, particularly ones that normally invest, you know, at Series B and Series C, and they're coming to us and they're reaching out to us in search of even earlier stage opportunities. So while the market's challenging, there's money available, and there's there is an interest in Series A opportunities.
Yeah, you're right, Ben. And you know, investors from experience, they know that startups that show promise in more challenging conditions tend to be among those more successful in the long term. So while deals these days are not as easy as they have been, they are still getting done.
Yeah, indeed.
Okay, it feels like founders did have an easier time in their previous fundraise. Many of the founders watching us today will have raised angel or seed rounds when investment markets were more active, like in 2021. Do founders need to change their expectation going into Series A fundraising? Maybe, Marie, for you, the question.
Yeah, you know, Victoria, this is without a doubt a more challenging time to be a founder today. Fundraising puts pressure on founders. Now, more than ever, it's a full-time job on top of the real job of lending customers and running the business. So it really takes many months to get a fundraising over the line. This is true.
Yeah, for sure. The rounds are taking longer. You know, based on our experience over the last year or so, it's a good 9 to 12 months from start to finish to close a Series A round. At the same time, the founders are up against a lot of competition from other companies for venture capital. The venture capital investors, the core investors, they're receiving lots and lots of opportunities, sometimes dozens a week, dozens of pitch decks that they have to review and assess. The volume is really something. So now more than ever, founders really need to cut through all this competitive noise, stand apart from other startups in the marketplace, and get investors excited quickly, get their attention quickly.
Yeah, indeed. And you know, we help founders articulate messaging and investor proposition to bring to light their real growth potential and the value promise. Investors nowadays are getting more rigorous on their assessments. Initial reviews are tougher and more stringent. So this is true. Due diligence is taking longer. And investors are spending more time looking at the market and the competition. They're also spending more time to talk to startup customers and partners. And they are even comparing notes with other investors.
Yeah, and I think really interesting recently is that investors are deploying really powerful evaluation and due diligence tools. They're drawing on automated assessment platforms that allow them to quickly analyze startups' markets, their competitors, and their company histories down to quite a remarkable level of detail. You know, they're using machine learning analytics now, and they're predicting startups' return on investments and even the probability of investors of an exit. So it's important for founders to recognize that investors probably already know a lot about you even before you get your first meeting with them. So with that in mind, it's even more important these days that the founders are ready for the investors and that they have really clear, compelling propositions that can, you know, even take them a step further than beyond the information the investors have, which is down to quite a granular level.
Yeah, and as you point out, Victoria, you know, many startups founders heading into Series A rounds will have never experienced a funding environment as rigorous as today's. As a result, our access to finance team work has expanded from advisor to coach. So that's why we spend time helping founders mentally prepare for investors and the fundraising journey, which is quite longer now. So our job is to ensure that founders have the highest level of preparation before they reach out to the great networks of investors.
Yeah, I mean, when we work with a company, we think, you know, we need to prepare them like soldiers for, you know, quite a rigorous fundraising campaign. Founders, like anyone that's well prepared for a tough journey, the more ready they are, they usually find that the journey is not nearly as difficult as what they might have expected. So preparation is really key. Founders that aren't prepared can find the fundraising quite grueling and stressful. So venture teams that are well prepared, they can demonstrate strong investment propositions and connect with the right investors. You know, they are successfully closing deals right now, but preparation is really key.
Indeed.
Yeah.
And, you know, dry powder is ready, as I mentioned before, and waiting for great businesses that are really well prepared. So I would say we invite scale-up CEOs to let us help them get that dry powder to access the billions in venture capital still available to fuel their growth.
Okay, but as founders face a more challenging funding environment, everyone is asking the same question. What can be done to increase the chances of funding success? Is there a formula, Ben?
Good question, Victoria. Yes, there's a formula for fundraising success. It hasn't changed even with the market in conditions changing. It's just that the formula has gotten more important. In our view, there's kind of three pieces to the formula. The founders must, first of all, they have to be presenting a really compelling investment proposition to investors, one that, you know, is going to resonate. It's going to make them confident that the business is going to be able to generate a return that can satisfy their limited partners and the partners in their funds. The second thing is that they need to be talking to the right investors. There's no point wasting time. it's a busy time to be, fundraising is a really, really busy time. So it's important that they talk to the right investors and not waste their time talking to the wrong ones. And then thirdly, key is running a structured, organized fundraising campaign to make it more efficient.
Indeed. And on top of that, in my view, strong proposition, which have the following features, can also make the difference. First, show that you have a resilient and impulsive team. Then, second point, the technology, it's key. And if you show that your technology stands apart and on top of that is protectable, then it's really valuable. The third point, really key, is the strong commercial traction. Ideally, if you have already very brand name customers that validate your product, this is really important. And then finally, of course, the market size and the growth opportunity, because as you know, priority for VCs is to be sure that you have a market potential and high success of growing. So they even want to see that the market size you are addressing is large.
Yeah, indeed. Just thinking about those points on what makes a great proposition. We recently raised money for a company called Sidekick Health. We helped them raise 20 million euros in funding. We brought in new investors from Germany, Wellington Partners, Acibis Partners. It was a great fundraising. Part of much of that was down to the proposition of the business. Sidekick Health has a gamified digital care platform for chronic disease patients. They're solving a big problem in the medical healthcare world. They're selling to the world's biggest medicine makers, i.e. big pharma, and they're bringing those companies on as customers and partners. So great commercial traction, supermarket size, technology that stands apart from anything in the market, and importantly, Sidekick Health was founded by a really impressive, experienced team. So all this kind of came together to make a really great proposition for the investors. So these are key. But just taking it a step further, there's a few other things that investors are looking for even more than those basics these days, and that's we think about it in terms of market pain versus vitamins. So investors now are really interested in companies that can demonstrate that they are selling solutions that are must-have in their marketplaces, not just nice-to-haves. The investors are looking for companies that are delivering solutions that are solving really burning pains that companies have to solve. They don't have a choice but to buy these products that the companies are making. So that's really key. Market pain versus vitamins. Webio is a company that we raised money for. Webio is based in Dublin. We raised 5 million euros for them last year. The key investor was Finch Capital in Amsterdam. They have a painkiller in the market. They specialize in conversational AI, and particularly it's focused on credit and collections. Finch Capital recognized that Webio had built a genuinely must-have solution for companies that are trying to collect payments and debt from their customers in a sensitive way, and they need to have it automated, particularly under new privacy rules. That kind of must-have in the marketplace, and particularly coming forward, was really a game changer for Webio, and it really captured the attention in the marketplace. Beyond having a must-have solution, the next thing that investors are really looking for these days is capital efficiency. The investors are getting pickier. They're worried about risk, so they want to make sure that companies are, when they make money, they're spending it well, they're investing it well in the business, and generating a return from it. Money's getting more expensive. Interest rates are rising, so investors are looking for more closely at how well founders are spending the money. So they're looking at metrics like customer acquisition costs, monthly net cash burn, and at the same time, the investors that you meet at Series A, they're going to be looking at how you've spent investments in previous rounds. So if you raise money from angel and seed investors in the past, they're going to be scrutinizing how you've used that capital to help to grow your business and create value. So the investors looking at capital efficiency, they love bootstrap companies. This is sort of the top of many of the funds' wish lists. They want to see, ideally, they want to see companies that have raised minimum amount of capital already.
Okay, so raising is one side of the medal from what I've heard from your answers, but at what costs? What about valuations? I'm hearing about more down rounds these days. Can you shortly explain what a down round is, and are down rounds inevitable for companies going to a next fundraising?
Sure. Yeah, okay, down rounds. A company faces a down round when the pre-money valuation of their current round is lower than the post-money valuation of the previous round. So in other words, they're offering shares to investors today to investors at a lower price than they previously had in earlier rounds. So basically, the valuations come down in the business. And this can be really quite unpleasant news for the company shareholders, its first investors, its founders, importantly, and even its employees that have share options. Down rounds are not great news, not very inspiring when you're going to market at a lower valuation than you had in the past. Not surprisingly, in the wake of the market turbulence of late, we're seeing more downward pressure on valuations, to be sure. The market headwinds and greater scrutiny from investors are certainly taking the steam off valuations. The froth is coming off of what was quite a hot, very noisy market, particularly in 2021 and 22. In overheated markets, even companies with mediocre propositions can attract investors' interest. But when markets get a bit tougher, and we are seeing that they're getting a bit tougher, valuations can drop, particularly from less interesting propositions, and the founders can face these down rounds. But still, good, strong, exciting tech ventures with compelling propositions, looking for the next round of investment, they're not facing down rounds.
No, but strong companies today are closing deals with quite good valuations and terms. We know this because companies that we support, so those ones who are well prepared and that offering a strong proposition and running also efficient campaigns, they are successfully closing rounds priced at a premium to the last ones. So it's still doable. And we have the great examples of one of the startups we supported this year. The company called Mitiga. It's a company from Spain. It's a climate tech startup we helped recently, and they raised a significant and oversubscribed amount in 2023 at a valuation level significantly higher than the previous round.
Yeah, it was a super deal. Mitiga is a really exciting deal that we've done. We just finished it up this month. Really pleased about that. No founder wants a down round. So our team works really hard to raise for the companies that we're supporting. We work really hard to raise their visibility in the market and work hard to bring to light to the investors the full value of their business. We want to make sure when we reach out to investors, when we talk to them, we want to make sure that they really understand what the real value of the business is so that we can get the maximum value possible. We work with founders to cut through the noise of the market. Importantly, connect you with the right investors, the ones that are going to most appreciate the value of your venture's promise, and increase the odds of getting the valuation that you expect.
Okay, Marie-Caroline, you mentioned Mitiga, which is a climate tech company. I mean, it's obvious, probably it's easier for climate tech companies to raise capital now because it's everywhere in the news and it's a big problem. It's a huge problem, the biggest one we have. But are there technologies or sectors that investors are most interested in these days and where it's easier to raise around? I mean, climate tech is obvious, but what are the hot digital tech sectors these days?
Good question. Thanks, Victoria. So, tech sectors go in and out of fashion, and it can change quite often. So, but in our team, we keep an eye on what tech sectors are hot. That's because there is a clear tendency for Series A investors crowd around tech sectors that they believe are set to grow over the next 10 years. But nowadays, I would say investors in the deep tech areas are really looking for opportunities in health tech, energy and clean tech, climate tech, and also food tech.
Yeah, some of the, I mean, there's climate tech as well, as we mentioned, but some of the other tech spaces that are, really kind of gaining attention, mobility still, things like quantum computing, the real deep tech stuff in quantum computing and artificial intelligence. And then, can you all guess probably what the hottest sector right now is? It's probably generative AI.
Indeed.
That's super hot right now.
Yeah. And VC investors, they like sexy sectors. So company operating in sexy spaces will have an easier time attracting investments. And we make a point of knowing which sectors are top of investors list, where they both want to direct, their capital. So we know that if a company can find a credible way to position itself as part of one of those sectors, it will make it so much easier to get investment from investors.
Yeah, that's right. A company that comes to mind is DC Brain. We helped the company raise money last year. It was a €5 million fundraising. DC Brain is an AI-based engine that optimizes supply chain and logistics. Supply chain and logistics is actually a pretty good market, but when we started working with the company and preparing them for market, we recognized that a lot of DC Brain's customers were in the energy space. There's kind of a sustainable energy play here that we spotted. So rather than positioning DC Brain in the investment market exclusively as a supply chain business, we highlighted to investors its positioning in the smart energy space. So in a way that would resonate with the growing number of sustainable energy funds. And as a consequence, reaching out to the slightly different group of investors in renewable tech and energy, we successfully raised the €5 million from Statkraft, which is one of Europe's largest renewable companies with a corporate venture arm. So it was an interesting example of how we positioned a company that was already in quite a hot market into an even hotter market, into climate tech, and it made a big difference in the fundraising.
Okay, I understand it's easier for startups from these hot sectors. We talked about climate tech, energy, but what about companies operating in sectors that are not flavor of the month? Marie-Caroline, maybe you.
Yeah, of course. So, deep knowledge of different kinds of investors and also knowing their unique preference makes all the difference. And this is where we have our intimate knowledge, of the venture capital investors, because we identified the right investors for the right company and ones that will truly get your proposition, whether the opportunity is in vogue or not. This is really important for us to get you to the right investors.
Yeah, it certainly is. We, our job is to get to know the investors all over the place. So we get to know the specialist sector-focused VC funds, one with a specialty focus that, probably they aren't always looking at the hot, sexy sectors or technologies. They're looking for ones that they know and understand, and they can bring value to. We know the corporates that are looking for strategic investments that can advance their parent business goals, ones that aren't necessarily looking at purely financial returns. Many of the family offices we're getting to know. Family offices are really important because they don't need to justify their investments to limited partners because they're using a pool of family money. So that means if there's limited partners that are putting pressure on fund managers to get into sexy markets, the family office can kind of resist that.
And also, I'll say that we are independent, and we have this chance to have the team located across Europe. So we know how to find the right investors, and it's a really critical step to get a success in the fundraising campaign. So the challenge for founders is really to figure out who are the right investors in Europe.
Yeah,
okay,
certainly.
so that means that founders need to acquaint themselves with the right investors if they want to get a deal done, right?
Yeah, it certainly helps. We think it's really important. Founders need to be engaging with the right investors. Again, ones that can appreciate the business and have an an appetite for the offering on the table. I'm just going to think of an example. Without naming names, I'll just talk you through a company that we supported. When we first met this particular tech company, when we met the founders, the business was kind of floundering in terms of fundraising. The founders were, they were actually close to giving up on their fundraising efforts. They were getting worried. As I recall, their cash runway was shrinking, and they were even considering scaling back their growth plans and going into bootstrap mode. But they came to us to find a better way to raise the capital because they were having so much trouble getting investment. But when they sat down with us, it became plainly obvious, to us at least, that despite having a great technology business and a pretty good team, they'd actually been approaching the wrong investors, and the ones they had, they just weren't the right fit for them. So for this particular company, we knew the company required pretty patient capital, investors with some deep pockets, a solid understanding of their target market, and really a belief in their business model. The funds that they had been meeting, they were too small, probably too generalist, and they didn't understand the tech. And many of them were insisting on more sales traction, and they didn't really appreciate the promise of the business. But what we did is we sat down with them again, and we kind of reworked the proposition for them and the investment materials, and we built a much more targeted, but significantly longer list of investors. We identified well-matched, qualified investors, not just from their region, but from all across Europe. Plus, I think even some US and some Asian investors.
Yeah, and at the end, we embarked on a fresh campaign. So we reached out to more than 100 investors for this company, and this generated almost 25 first meetings, and also 3 term sheets at the end of the process. So the result was good. It was great. It was a syndicated Series A investment led by one of Europe's largest corporate venture capital funds, with a co-investment from a specialist fund with expertise in their target market, which was great for the team, and further co-investment from a corporate with complementary solution for the company.
Yeah, it was a nice one. So this the Series A funding, it gave these founders the fuel they needed to keep the sales growth going. It was a great success story for us, and it wasn't long afterwards that the company was actually acquired. So that was a really exciting payoff for the founders and all their venture investors. It was a good example of how we were really able to reposition the business for the right investors that could really understand what they were doing and could and get the right match, which is really, really important.
Indeed. So what we provide at the end is really and this is a big part of the work we do for the companies we support. First, we qualify the suitable targets based on the sector preference of the company. We also stay focused on the stage development phase, and also we can also deliver on the track record. So it's really a big part of the work we do for our startups. Yeah. So working with an experienced team and an experienced fundraising advisors like the EIT Digital Access to Finance team can really help founders. And on top of that, this is for them a way to not spend their precious time talking to the wrong investors, because with us, they will get access to the good investors in Europe.
Yeah, we want to get you the right investors. So, and kind of with that in mind, really important in the fundraising, getting success is knowing which of those investors from all over the place have the interest and capacity to lead on the deal. It's, getting a lead investor is really key in the fundraising campaign. So when we build the target investor lists with the companies, we make sure we have a good idea of which of those target investors are going to potentially take the lead and be offering the first term sheets in the round. So these investors need to be given kind of VIP or priority treatment. And getting a lead can be really key because it can smooth the whole process of the deal making and make the fundraising a lot quicker and easier. So we kind of set our sights first on potential lead investors, but knowing who the lead investors are requires understanding who the funds, understanding the tastes and preferences and styles invested in the funds. So for fundraisers, for founders that aren't using an advisor, this requires an awful lot of homework. They need to know who these investors are on their own. From a whole vast number of them from all across Europe. So we recommend founders, save themselves the time and effort and work with a team of advisors like us to help them hunt down the lead investors and bring home these deals in a more timely manner. Yeah.
Okay. There are now hundreds, if not thousands, venture capital investors across Europe. How do you identify the right investors from so many different groups? And how do you actually keep a good relationship?
Yeah, thanks for this question, Victoria. It's really important and it is key to keep a good relationship with investors, but it's not an easy task because there are now thousands of investors in Europe looking at early stage venture opportunities. And they are not all the same. Their investment focus differ. The technology and sector focus also differ. The taste and preference are different. So CEOs and founders, they really want to find an investor who has a good fit, but also want to find the right investors is always a difficult part. So it's not easy for them. And this is also why we really want to highlight that it is our focus.
Yeah, it is. We, if you think of the venture capital investment market like an iceberg, I mean, some of you might have seen the slide that we put up in previous presentations, but think of the VC market as an iceberg, and sitting above the surface in plain sight, above the surface of the water, are those big brand name investors. There aren't that many.
Probably like Excel.
Yeah, Accel,
Orbit,
Notion Capital, the big names and super investors. They've got big funds. They actually invest in promoting themselves and making themselves known to the market. They're pretty easy to find, but they're super busy. They're so big and they promote themselves. So there's like tons and tons of founders trying to access them, which can make it difficult to kind of get their attention. But again, going back to the iceberg, if you think about what's sitting below that surface and less visible, there is a huge universe of investors under there. Like, as we said, there's 1,000+ investors investing at venture stage. They don't spend so much time promoting themselves, but they are quietly making investments, and they're bringing huge value to venture capital rounds these days. There's corporates. Some are well known, but there's some corporate investors that are less known, some smaller corporates. There's super angels, high net worth individuals. They typically don't want to promote themselves because they have that's not their job. They just want to find good deals. Again, there's family offices that are quietly investing away. And then there's a kind of a new breed of venture stage investors that are coming from funds that are traditionally don't invest in VC. Like, there's private equity funds that are investing in venture capital stage businesses. They're asset managers. Some of the biggest asset managers in the world are investing in VC stage, and even some of the hedge funds. So there's this huge group of investors, and many of them are lesser known to founders.
And the amount of information available about those investors is limited, and getting it takes time, So Founders can check their website, of course, or learn about them from the press. They can also talk to CEOs that know about them. But many of those investors don't promote themselves too much. Many operate quite quietly under the radar, so it really takes time to research and effort to research investors and the right ones.
So the founders can get our help. So we know an awful lot about the market. Our job is to get to know the investors, understand their tastes and preferences, and we can direct the founders to the right investors with the capacity and the knowledge and the expertise to participate and importantly to lead rounds. Yeah.
Okay, but how do you actually keep a good relationship with investors, Ben?
Good question. You asked that before, and I kind of skipped that. Or we did. So the key to
I hope not on purpose.
Yeah, no. So no, the relationships with investors is really important to us. So how do we keep the relationships? Well, the most important thing is they know us by reputation, and our reputation is that we bring them high quality deal flow. With the companies we work with are strong. They have great propositions. They have great teams. We vet them. We don't work with every company that comes to us. We only work with companies that we think are of great potential to be doing fundraisings. They may not have all the right pieces in place when we meet them, but we work to make sure that they're ready for the market and they make good propositions for investors. So the key to our relationships with investors is, we're working with great companies, we're identifying the best founders and getting them ready for these investors. So they know, they answer our emails because, and they answer our phone calls because they know that, we're providing them with great
and also, Victoria, I think absolutely, Ben, and I think because we bring this very high quality deal flow to the investors, they trust us, so they really want us to be in contact with them very regularly, and they like the deal flow we provide to them.
Yeah, I understand, and probably also the network we provide, not only the startups but also other organizations, corporates, and so on. Okay, but what is the best way for founders to engage with investors then?
Okay, I'm just going to be straight and frank. By far the most efficient, best way to access investors is through introductions. There's kind of a pecking order in the world of venture capital when it comes to accessing investors, and not the top of the pecking order is warm introductions. The venture capital investors love getting introduced to great startups from people that they know, from people who they trust, and groups that they trust. They use they use them as filters. Yeah.
Okay, but what about existing investors? Shouldn't they normally make any introductions? So if a startup is looking for a Series A round, they have already investors on the cap table that can make the introductions, right?
Sure, that's absolutely. They should. Founders should definitely be asking their investors to make introductions to new investors for them, to ones that they know. But of course, the investors they introduce may not be the right ones for the company. So it's really important that they're looking beyond the investors, that they're beyond the funds that their own shareholders are introducing them to. There can be conflicts of interest when it comes to when investors are making introductions to other investors. So in our view, having an independent third-party advisor can be really, really helpful. Yeah. But yeah. Talk to their investors, get the warm introductions from your investors, get your warm introductions from lawyers, accountants that or turn to advisors like us who really understand the market and who have big networks of investors. The other approaches are attend trade shows and investor events, pitch events. These can require a lot of time and effort. But definitely worth doing. And then there's kind of the old cold email and LinkedIn approach to contacting VCs. This can certainly work, but it takes a lot of time and effort. VCs say that they like to get cold emails and they like to get submissions through their websites, but to be honest, if you sit down with a venture capital investor and, maybe over a couple of cold beers or glasses of wine, many of them are going to tell you that the cold emails are not the best way to reach them. A lot of these emails get ignored because they're just getting so many. So take every opportunity you can to try and access investors through all these routes. But I think warm introductions are the best way to do it. Founders can make their lives easier, and the fundraising
Indeed.
can be a lot more efficient. Yeah.
Yeah, and venture investors know us, so they know that EIT Digital supports only businesses that have the potential to really get access to this financing. So they see us at the end as a trusted source of strong deal flow. And as a result, what do? They respond to the phone calls, they answer our emails, and they suggest meetings with us. So rather than spending a huge amount of time accessing investors or wasting time talking to the wrong ones, I will really encourage every founders that we can take you through this strong network of investors.
Okay, so talking about time, when is the best time for companies to contemplate a Series A fundraising?
Victoria, there is no concrete answer on when the best time to raise is. It really depends on different factors, and it depends also of the sectors. For example, SaaS companies are usually considered as ready for a Series A round when they get the 1 million euro revenue in annual recurring revenue. But companies with revenue anywhere between 500K and 1 million euros can raise, of course. It really depends on the maturity of the product and also the business sector of the company.
Yeah, absolutely. So there's kind of that magic 1 million annual recurring revenue for SaaS businesses, and that's still holding firm. But you know what? There are a lot of other businesses that are raising Series A and they have less revenue than 1 million. They tend to be in the kind of the deep tech space. So if you've got fantastic technology that's kind of world class or really, really, holds huge potential, the investors are interested in investing in the deep tech as an asset. And companies with great tech can typically raise Series A at lower revenue thresholds. Startups, the investors are looking for, they usually have anywhere between 10 to 50 employees at Series A. So but the key is really to have teams that are really focused on accelerating growth. They've got a product that's ready to scale and really explode the marketplace.
Okay, but talking about profitability and deep tech, do they need to be profitable, those deep tech startups? Because nowadays investors, they're looking for opportunities that are profitable or close to profitable, maybe.
Sure, Series A funding is generally provided to companies that generate revenue but aren't necessarily making a profit. Certainly these days, risk-averse investors are looking for companies that can demonstrate that they are on a pathway towards profitability. I think that's becoming more important. As I mentioned before, there's kind of this focus on capital efficiency, and kind of in tandem is this, they're investing in companies that think, we'd like to think that this company is going to be profitable in a not too distant future, just to kind of mitigate risk. But really, it's about growth on the revenue side, and the investors are looking, it all varies, but typically 15 to 20% growth on a monthly basis. But again, profitability, show that there's a clear way that the company is going to get to profitability. That's really desirable. It's not a requirement. Unit economics in the business are really important. Having a business that's healthy, that you can show you can eventually cover the team's costs and profitable one day. That's not a bad thing to have when going out to investors.
Okay, so when I talk to founders, a lot of think that investment materials and documentation need to up to scratch. Tell us, what's your view on presentation decks and teasers?
Okay, so Victoria, our team has been involved in hundreds of investors meetings. So we saw many pitch deck and presentation in the past. And I think our unique perspective has given us a lot of insights about what makes really a great investor pitch. So it's tempting for founders to see the deck as a document that will educate or inform the investor. But I think it's wrong. And it's better to think of the investment deck as a selling document.
For sure. Fundraising campaign is a sales campaign. So you're selling the opportunity to investors. You're not trying to make them smarter. You're not trying to make them educated. It's about, at the end of the day, you're trying to get a deal done. And so it's a sales process. So the founders really need to, when they're preparing their materials, they really need to ask themselves, what's this pitch deck for? So a few things to think about is basically it's a document to get the first meeting with investors, get their attention quickly, provide just enough information for them to think, aha, this is an interesting company. It kind of matches with our fund thesis or our interest in investment. It's telling me, it's a preparation for a conversation. It's providing, just the right basic information to answer, to make them comfortable with the opportunity. And importantly, it's telling a story about where the business is going. It's compelling, it's inviting questions and discussions. It's the pitch deck doesn't need to provide all the details. It's a door opener. It's to start the conversation. And as the founders will find, as they kind of move through the fundraising campaign or journey, there's going to be lots and lots of questions from the investors as you meet with them in your second, third, fourth, fifth, sixth meetings. There's data gathering, there's assessment, there's due diligence, and there's going to be lots of detailed probing. The pitch deck is just the very first thing. It's just a door opener, so it needs to be clear, concise, compelling. Again, cutting through the noise. So we recommend that the investors, as they're preparing the pitch deck, they think, okay, what are the 3, 4, 5 key messages that they really want to get across to the investors? Focus on those on the slides, and hit those messages hard, and make the best impression and sell the opportunity. Yeah.
Okay, great. Just looking at the time, I would like to ask 2-3 more questions. So I'd ask you to be very precise in the answers. I'd like to take one question from the audience actually right now, because I also had the same question. We talked previously about ticket sizes. How much equity do investors take at Series A? And maybe we can answer also Holger's question that he just dropped in the chat function.
I can start with this question, Ben, if you want.
Yeah, sure.
Yeah, so I would say from what we saw and with the experience we have for a Series A round, typical range in terms of percentage of equity will be from 15 to 25% of the total capital of the company. And I think it's key to keep that in mind because usually before the Series A round, the team did a pre-seed round. So it already happened that the cap table is already split with other investors. So for the Series A round, I will say between 15 and 25%, not more than that.
Okay, and then going back to the question we had before. So we talked about the pitch deck, and pitch decks can get attention of investors. But be honest, does getting a meeting with an investor mean that they want to invest? And how do founders actually keep investors interested once they've had a meeting and keep the momentum and keep them actually warm?
Oh, okay, I can take this.
And not to get ghosted.
Yeah. So VCs, remember, venture capital investors are professional negotiators. They typically hold their cards very close to their chest through the whole process, and they can be really, really hard to read. A good sign that they are genuinely interested in investing in your company is when they issue a term sheet offer. That's a good sign, but even that's not a sure sign. It's not until their investment is in your bank account that you can truly know that they were interested. So until the money's in the bank, you just don't know what's going to happen. So until then, as founders, you need to make choices about whether it's really worth dedicating time and effort into keeping conversation going with the investors. And that's difficult to gauge. Is the conversation going somewhere? or could it end up being a dead end where they just say no? It's hard to read. So in our view, it can be really, really helpful to have an experienced advisor like the people on our team, because we can help you read the room and you can help you assess the investor's interests. At the same time, all through the process, we're relentlessly following up with investors, particularly when they go silent, because they do go silent, even though they might be interested. They're busy, or even it's as a tactic they go silent. So we seek out their feedback, and we can use that information to pivot the messaging or respond to objections that the investors might have, or some uncertainty.
And it's really
our job to help you keep the meetings until we want to help you get the deal done. Yeah.
Okay, so I would like to ask the next question, because only one question left for the time. And Marie-Caroline, you talked previously about the equity that investors take, and it's probably a great signaling if investors participate in follow-up rounds. And it's also less work for the founders, as fundraising is a full-time job, as we've heard, especially when you look for new investors joining the round. How can founders balance fundraising with the equally critical job of building and growing the business? Or, in my opinion, it's even more important to actually build and grow the business and not looking for investors. But it's necessary to get the money, right?
Yeah.
Sure. I'll kick this one off. So there's tons of work to be done in the fundraising round. As I said before, they're taking like 9-12 months, sometimes even more, to get the deals done. There's lots of strategy and preparation work that's required, to make it, a timely, efficient fundraising. Messaging material that needs to be produced that conveys the proposition, that strikes chord with investors. There's a whole bunch of more things to do. Marie-Caroline, what else?
Yeah, and keep in mind that in average, the outreach can be to up to more than 100 investors with follow-ups, and founders. They have dozens of meetings with investors, and each meeting typically involves more follow-up work for the team. Because we have assessments, analysis, then we have also the phase of due diligence, questioning, and then if we get to the term sheet, there is also the term sheet reviews and an analysis, and then also sometimes more investors meetings after that, and at the end, for sure, the negotiations phase. And sometimes also securing co-investment syndication. So all this work involved many meetings and preparations. And meanwhile, founders and teams must stay really focused on the daily job. This is really important because they need to build and grow the business.
No, there's a ton of work to be done. Resources are required. Dedicated effort is required. In our view, though, founders need not do it alone. We're here today to invite you to help. Let us bring our experience, our expertise, our market network to your fundraising. The EIT Digital Access to Finance team, we're here to help you navigate the venture capital market and the whole capital raising process. We can help you shoulder the burden of fundraising, and really, as Marie-Caroline says, keep you focused on the really important job of bringing in sales and growing the business. We'd really like to help make your next fundraising more structured, more efficient, and really successful.
Yeah. Okay, thank you so much for the really interesting insights, Ben and Marie-Caroline. But we also received interesting questions. We received quite a lot, and I'd like to hand over to James now. I think we don't have enough time to answer them all now. We will answer some, and we will get back to you via email. So please also reach out to us directly, and we will also answer all the questions via email.
Yeah, thank you, Victoria. We've had some great questions. Let's get stuck into some of them because we're running out of time. Marie-Caroline, what is the typical timeline for a fundraise?
Timeline, I would say between 9 and 12 months nowadays.
It's taking longer.
And Ben, Dinesh and Spilios are asking, what are the terms of engagement?
Okay. Well, if you like what you hear today, what I would suggest is that we have an initial conversation so we can get to know each other a little bit better. We'd love to learn more about the businesses that are interested in fundraising. Love to get to know more about the founders. But the terms of engagement are we take a success fee on the front on the money that we bring into the rounds. It's a very competitive success fee, as you'll find out, and then we also take a modest base fee. That's not too frightening, but that's something that we can talk about. Happy to.
Great. And just following on, Ben, I think this must be a Brexit question. Do we support UK businesses?
Yes, we do. We certainly do. We're now supporting a UK business. We're preparing for fundraising later this year. The EU is very much part of the EIT Digital Access to Finance ecosystem. So please, if you're a UK company, come and talk to us about your next fundraising.
And Marie-Caroline, there's always this question about how the US market and the EU market compare. So how difficult is it in comparison to raise in the different regions of the world?
First of all, we should highlight the fact that we have a hub in Silicon Valley, so it's a great news for those who are interested in entering into this market. So we can help startups ready to scale across the US to go there, because we have a team, and we can of course prepare and coach accordingly the team to be prepared to this huge market in the US. But it is true that it's a different way of raising money there. And also because we have this strong team across Europe and also one in the US, we can approach it differently. I will be very happy to tell more about these differences in a different exchange.
Yeah, thanks. While Victoria is switching on her mic, should I say, please do use the contact details on the screen to ask any additional private questions that are maybe a bit more personal or private and don't want to be aired for everyone. Victoria, how do we support startups fundraising, and do we work in agri-tech? That came from Angus.
So we support a lot of sectors, a lot of industries. We focus on deep tech, but deep tech, it can be everything and nothing. So it really depends on the technology. It does sound a little more complex than it actually is. So we like everything that uses AI, machine learning, optical computing, quantum computing, Internet of Things, next generation networks. So if you're interested in fundraising and you're more in the earlier stages, just send me a message. We'll connect you. And also we also invest in pre-seed and seed stage companies, deep tech. So just let me know, send us an email, and we'll get back to you.
Okay, we're getting close to the end here, so I'm going to try and combine two questions in one. So Ben, do investors want profitable EBITDA positive companies? And I think this is coming from Andrea, who's got a capital intensive R&D business. Yeah. And secondly, do investors want to get involved in the management of the business, or can the company remain independent?
Okay, I'll start with the first one, just so because venture capital investors typically do not want to get involved in the management of the business. They like to help. They like to make introductions to customers and partners. They like to offer advice on, how to grow the business faster, but they typically do not want to be part of the management team. They like to think that when they're investing in a business, it's the founders that are running the business and making the most important decisions. Nobody knows more about your business than you do, the founders, and the venture capital investors know that. So that's important when you do go and talk to investors. You want to make it clear that you guys are in charge and it's your strategy going forward. They don't want to think that you're relying on them as managing the business. It's important to make that clear to them. Do venture capital investors look for profitable businesses? As we mentioned earlier, Not really. Their focus is on venture capital is really focused on helping businesses to grow. They want to invest in companies that have big markets. They want to help them grow fast. And the growth is typically top line revenue growth at this stage. They like to know that, yeah, there's a path to profitability, but they're not necessarily focused on investing in profitable businesses today. If you do have a profitable business that's EBITDA positive, it could be right for venture capital investors. It could be right for private equity investors that like to invest in profitable businesses. But
okay, well, I think
yeah.
we'll leave it there, and I'll wind things up, and we can carry this conversation on as the next steps. So next steps, I would strongly advise signing up to our free consultation call with me and the team. Please just use the QR code provided to book yourself in. We've recorded this event, so if you want to review it or share it with your colleagues, this will be available next week. So look out for that in your email. Lastly, we run numerous events throughout the year, so I'd highly recommend signing up to our mailing list on our website. The URL's there. This will keep you informed and provide insights on fundraising opportunities for deep tech startups as well as scale-ups. And so that we conclude today's event. I just want to say thanks again for attending, and look forward to seeing you on at the next event or on the free consultation call. And all the best for now. Thank you very much for attending. Bye.
Thank you.
Thanks, everybody.
Bye.